Time for Money Tuesday. We know money has certainly been tight for most of you. We've seen a topsy-turvy stock market as well. So why would we be talking about investing right now? Stewart Welch with the Welch Group joins us here with some of those answers when he looks at the numbers. Good to see you this morning.
Good morning, Mike.
Yeah, some people might wonder, hey, wait a minute now. You're going to tell me now's a good time to invest in the stock market, especially the way things have been sort of volatile lately.
Yeah, I think there's a big lesson here, and if we do a little bit of history, we looked at last year, the market was down 18%, and the year before that, it was up 26%. So you can see kind of the range of volatility, and when it drops 18%, a lot of people just bail out. They lose money. They might be first-time investors. They lose money, and they say, this is not for me, and that's not the lesson.
And we're talking about several types of people here. You got those who are just investing strictly in the stock market, those who have 401ks tied to this. But really, when you look at the numbers, and that's what we want to talk about, it's what the percentages are in terms of the gains if you stick with it for the long haul, right? Yeah,
I think when you look at the long-term numbers, the market is surprisingly stable.
Okay.
So if you looked at this is 5 years, 5, 10, 20, 30, 50, 100. If you look at those returns, they're somewhere between 9 and about 12%. So it's that long term, it's that sticking with it through thick or thin. And when you decide, well, what is the key to successful investing? This is a tough lesson, I think, for a lot of people. It is literally consistency of investing. It is dollar cost averaging, month in, month out. Doesn't matter whether the market's going up or the market's going down.
And so people understand, when you mention dollar cost averaging, that means every month you're buying something in. And so if the market's down, you're actually getting more shares at a lower price. And when it goes back up, the value of your account goes up.
That's exactly right. Yeah. And so it's, you and I talked about it, and like in your 401k, you're just keep plowing the money in.
Yeah.
And when the market recovers, you've been buying all those shares at cheaper prices, and now all of a sudden they're worth a lot more.
Now, real quickly, somebody who's getting close to retirement, when should they kind of pull back though?
So I think I would say within 10 years, you want to begin to actually build up some cash, or let's call it money market account. Mm-hmm. And you want to have, by the time you're retired, you want to have somewhere between 3 and 10 years worth of cash to cover lifestyle expenses. So if you're spending, $30,000 a year, you need in 10 years you need $300,000. That's in order to cover that. And that's to get you through those big downspouts in the market.
All right, well, that's some good advice right there. Stewart Welch from the Welch Group, we do appreciate it. Thank you.
Thank you, Mike.
All right, we got more ahead, including Good Day Buzz. Stick around.